Chapter 3, Introducing Financial Statements. The bar is in full swing, and floating rounds of cocktails permeate the garden outside, until the air is alive with chatter and laughter, and casual innuendo and introductions forgotten on the spot. F. Scott Fitzgerald from The Great Gatsby, Chapter 3, 4th paragraph. In this chapter, you'll be introduced to the financial statements of firms. It will be sort of like meeting someone for the first time at a party, perhaps along the lines of, Sarah, this is Chris. Chris, this is Sarah. Once introduced, you know each other's name and a bit about what each other looks like, but not a lot else. To really get to know someone, you need to do more than simply be introduced at a party. But once you are introduced, you can get to know each other better. You can talk to each other about where you're from, what you do, what music you're interested in, what movies you may have seen recently, and then later about deeper and more personally meaningful things about each other. But at parties, many people do not necessarily do this. It can be so easy to skate over the surface in our relationships and to not really be that interested in the people we meet. It is the same with being introduced to financial statements, maybe for the first time as you read this chapter. You might feel a little bit shy, perhaps a bit overwhelmed or worried, even though you may try to maintain an image of cool confidence in front of your friends. When Chris and Sarah are introduced at a party, they are each much more than simply their names. But for getting to know each other, it is a good place to start. It is the same with financial statements. We will see there are 4 general purpose financial statements some businesses are required to provide: the balance sheet, income statement, statement of changes in equity, and statement of cash flows. And quite often firms have 2 income statements, as is the case with Ryman Healthcare. So in that way, there can be 5 general purpose financial statements. But there is much more to a firm's financial statements than simply their names. Each of us are different, and we'll see that firms and their financial statements are each different as well. The rules do not cover every aspect about how firms set out their financial statements, so different firms will set them out in different ways, though there will be some general patterns they will use. We will also see there are no rules about what we call each item in the financial statements, or even the names we give the financial statements themselves. So there can be different names used for the same or similar items. It is like how most people have 2 eyes, a nose, and a mouth, yet all of us have different faces with which we use to communicate with those around us. As part of getting to know the ideas, concepts, and facts about financial statements, you'll need to be able to recall some things, just like remembering someone's name at a party. If Chris and Sarah are introduced to each other at a party and then an hour later bumped into each other again and neither could remember each other's name, how far is their relationship developing? Not very far. They really know nothing about each other, not even each other's names. It is very difficult to remember anything unless we are interested in it, and it means something to us personally. Not remembering someone's name probably means we are not very interested in them. But when we understand something and what it means to us and how it is connected to our lives and to our prior knowledge and previous experience of the world, then we generally just remember it. We do not have to try to, we just do, including remembering someone's name who we're interested in. In this chapter, you will have the chance to be introduced to 4 or 5 financial statements, like being introduced to 4 or 5 people at a party. You'll then have the chance to think about how we can make sense of a firm's financial statements, including how they can help us understand how firms add value in business. So, welcome to the party. Okay. Some parties we may look forward to more than others, but we can always be surprised. 3.1. A view of business at rest. The financial highlights offered at the beginning of the report tend to focus on what they, the company, want you to see. But that's just an appetizer. The second course, the big plate of meat and potatoes, is the financial statements. Richard Loth. Now, what do financial statements look like? In the annual reports of your firm, you'll likely see lots of glossy photos with happy people and sunny skies everywhere, and often with optimistic comments from the chairman and managing director. You'll see heaps of words and photos. If you think your firm's annual report is not a marketing document, think again. It is a marketing document. By this I mean the firm's management is seeking to tell you some stories about their firm. They want to communicate to you messages they want you to hear and to influence your behaviour, particularly if you're an investor, but also, for example, to help their staff feel good about the firm they work for. You'll see at the back of your firm's annual report that there are a lot of numbers and some words in a few tables with headings like balance sheet or perhaps consolidated statement of financial position, income statement or perhaps consolidated statement of financial performance, statement of changes in equity, and statement of cash flows. A firm's annual report is the whole glossy document. The financial statements are part of the annual report that usually comprise a balance sheet, income statement, one or two, statement of changes in equity, and a statement of cash flow. They also include a statement of accounting policies, a great long list of footnotes, and usually a 5-year summary of some key financial and non-financial information. In this section, we will have a look at the balance sheet. As we do this, we will start thinking about how we could ever possibly use these financial statements to engage with and connect to what is really going on in our firm. And just as I like to introduce my friends at parties to new people, let me introduce you now to the balance sheet. Balance sheet. A firm's balance sheet shows its financial position on a day. That is right, on just one day. Have a look at your firm's financial statements and look at its balance sheet. You'll see it says in the heading that its balance sheet is at a certain date. At the top of Ryman Healthcare's balance sheet, it says consolidated balance sheet as at 31st of March. A firm's assets, liabilities and equity are shown in its balance sheet as at a certain date, say 30th of June, 31st of March or 31st of December, or whenever its balance date is. A firm's balance date can be any date. Many companies will use the same date as the end of the normal tax year in their country, which is 30th of June in Australia and 31st of March in New Zealand. However, there are a range of balance dates used by different companies. As we saw in Chapter 2, Section 2.3, we want to know what is happening to a firm at regular intervals during its life. Now, businesses have a lifespan, just like we do. Some shorter than others, others longer. Again, just like us. But usually we are not prepared to wait for the firm to go through its entire life before we assess how well it is going. We want to know how it is going along the way. You'll see in your firm's balance sheet it includes assets, liabilities and equity. You may remember we talked about what assets, liabilities and equity are in Chapter 1, Section 1.4. They are 3 of the 5 elements of accounting. The balance sheet gives us a picture of a firm's assets, liabilities and equity on a given day. Balance sheets are usually produced at least once a year. This gives us a chance to see these 3 elements of a firm's accounts each year, rather than wait until the end of a firm's life. Have a look at your firm's balance sheet. There's no required format, so you'll see different firms will set out their balance sheets in different ways. There are also no standard terms to use for different items, so different firms can tend to use a range of different words for the same item. But just as we each have a different face, so our faces also have some similarities. You'll see a few similarities between the balance sheets of different firms. For example, you'll see next to some of the items numbers referring to specific footnotes. In Ryman Healthcare's balance sheet, next to the item property, plant and equipment, there is a reference to footnote 6. When we look at footnote 6, among the footnotes there are 2 pages, yes, 2 pages, of further information about Ryman Healthcare's property, plant and equipment. Ryman Healthcare's balance sheet fits on 1 page, but the footnote for just one of the items on its balance sheet, property, plant and equipment, takes 2 pages. No need to worry about all this detail in the footnotes yet. You are just getting introduced to your balance sheet, like Chris and Sarah being introduced at a party. There is much more to get to know about each other than simply being introduced, but introductions are a good place to start. You'll see there are lots of footnotes next to many of the items in your firm's balance sheet. Have a quick look at some of these footnotes. Do not get worried about trying to understand them. Just have a quick look at them. Your firm's financial statements include the footnotes. So reading the footnotes is part of reading your firm's balance sheet. But we do not usually read through the footnotes in one go. Rather, as we look at a balance sheet, we can refer to the footnote that relates to a specific item to get further information about that item as we wish. The use of footnotes gives us an uncluttered balance sheet, providing an overview of a firm's financial position, not just on one day, but also usually on one page, with a lot more of the details included in the footnotes, which are available to us as we need them. Not just one company. Your firm's balance sheet will show the balance sheet of a group of companies comprising the total economic entity controlled by the parent company's management team. It may or may not also show the balance sheet of the parent company by itself. For example, your firm may provide a consolidated balance sheet and a company balance sheet. If it does, you can ignore the parent or company accounts. We are only interested in the group or consolidated accounts. This applies to the balance sheet and to each of the other financial statements. Almost all listed companies will not just be one company, but a group of companies. This means there is a parent company, which is the company you buy shares in, should you buy shares in your firm. This company controls several subsidiary companies, which typically means the parent company owns between 51% and 100% of the shares in these companies. Though the parent company of your firm controls its subsidiary companies, that is, the parent company's management runs the group of companies as a single economic entity, calling the shots in the subsidiary companies, it may not necessarily own all of the equity in its subsidiary companies. You'll be able to find a list of all your firm's subsidiary companies along with the shareholding the parent has in each of them in one of the footnotes in your firm's financial statements. In Ryman Healthcare's annual report, in footnote 22, there is a list of its subsidiary companies. All of Ryman Healthcare's subsidiary companies are 100% owned by the parent company. Most subsidiary companies are named after one of its retirement villages, such as Anthony Wilding Retirement Village Limited. So your firm's balance sheet will show the balance sheet of a group of companies comprising the total economic entity controlled by the parent company's management team. We are only interested in the group or consolidated accounts. This is because we are interested in understanding what is going on in the group of companies that are controlled by the management of the parent company. This is the economic entity we are interested in understanding. The parent company's accounts are usually of little interest to us as they relate simply to that part of the activities of the firm that happen to reside in the legal entity of the parent company and ignore all the rest of its activities that are held in corporate legal entities separate to the parent. Whether certain assets or liabilities are held in a firm's parent company or in a subsidiary company does not really matter to us, except in one aspect. Your firm, like Ryman Healthcare, may have only 100% owned subsidiaries. However, your firm may have some subsidiaries that are less than 100% owned, say 51% owned, by the parent company. In this case, the parent company does not own all the equity in these partly owned subsidiaries. Someone else owns some of this equity, and they are the minority shareholders, called non-controlling interests, in the partly owned subsidiaries. You can quickly tell whether your firm has any partly owned subsidiaries by looking in the equity section of the balance sheet of your firm. If you see an item in your firm's equity called non-controlling interests or minority interests, you know it has some partly owned subsidiaries. An item called non-controlling interests or minority interests in the equity of your firm's balance sheet represents the equity in the subsidiary companies not owned by the parent company, and so not owned by the equity investors in the parent company. It is the bit of the subsidiary companies owned by someone else. We have seen the consolidated balance sheet of your firm shows the assets, liabilities and equity of a group of companies, not just the parent company. If there are some partly owned subsidiary companies controlled by your firm, the equity interests of the minority shareholders in those subsidiary companies will be shown as non-controlling interests or minority interests. Ryman Healthcare owns 100% of all its subsidiary companies, so it has no non-controlling interests in its balance sheet. You'll probably also see that your firm has 2 years of numbers in its balance sheet. It is usual to include 2 years of numbers. If the accounting policies of your company in both years are consistent, the amounts for each item can be easily compared between the 2 years to see what has been changing and what has not. Setting it out this way makes comparing numbers between the 2 years easier. We've seen that a firm's balance sheet shows the position of a firm at a certain date. But we know that business is not static. It is on the move all the time. There are things happening to firms every day. Your firm will be changing all the time. It is changing today as you read this study guide and as you look at its financial statements. Let me now introduce you to 3 other financial statements that show a firm on the move over a period, showing what is happening between each snapshot in a moment of time given by a firm's balance sheet. 3.2. Business on the move. To live in Australia permanently is rather like going to a party and dancing all night with one's mother. Barry Humphries. A firm is forever dancing with others, exchanging value in markets as it seeks to add value to its equity investors. Businesses are active, doing things all the time. For this reason, firms are changing all the time and can often be very fast-moving. One of the exciting things about running a business is facing all the challenges that arise each day. It is true some businesses may move more slowly and be more boring than others, and may feel a bit like Barry Humphries, a well-known Australian comedian, dancing with his mother all night. For other firms, the ride can be more exciting, but whichever way it is still a ride. Business is not about sitting still on the sidelines. It is difficult to see this changing world of business from a firm's balance sheet. The changes in a firm's balance sheet from year to year give little information about the many steps involved in moving the business forward from the end of last year to the end of this year. 3 further financial statements tell us something about what has been happening on the journey or movement of a business between the snapshots of 2 balance sheets. The key one is the income statement, which shows the revenue and expenses and the profit of our firm over a period. The other 2 financial statements give us insights into how 2 key items in our balance sheet have changed: equity and cash. First, let me introduce you to the income statement. Income statement. Mega corporations have a huge influence on our daily lives and are generally only concerned with one thing: the bottom line. That is, maximising profit regardless of the social or environmental costs. David Suzuki. A firm's income statement shows how things are changing in a firm over a period, usually 1 year. We saw in Chapter 1 that the view of business underlying accounting sees everything a firm does as affecting itself and its equity investors, and no one else. So it should come as no surprise that the income statement shows how the various activities of a firm during a period, usually 1 year, have affected the equity investors. The income statement shows a firm's revenue and expenses. Revenue less expenses equals a firm's profit or income for a period. This is the bottom line of your firm's income statement. As you look at your firm's financial statements and compare them with the financial statements of other firms, you'll see how different firms can set out their financial statements in quite different ways. That is fine. Generally, there are only limited rules for how we set out our financial statements, or even what we call different items. So we see lots of variety in how financial statements are presented to the world. But the concepts and ideas embedded in the accounting numbers are basically the same. In your firm's income statement, you'll see various revenue items and some expense items. You'll see most expenses of your firm are probably not disclosed. This is because there is no requirement on firms to disclose most of their expenses, so they usually do not. You'll also see that just like the balance sheet, there may or may not be two sets of income statements. One may be headed group or consolidated, and another may be headed parent or company. We are only interested in the group or consolidated accounts. These numbers include all the revenue and expenses of a group of companies and all its profit or loss, which equals revenue less expenses. Where a parent company does not own 100% of the equity in all its subsidiary companies, not all the profit or loss of the group of companies will be for the benefit of the equity investors in the parent company. Some of it will be for the benefit of minority investors in the partly owned subsidiary companies. In such a situation, you'll see non-controlling interests or minority interests deducted from profit or loss in a firm's consolidated income statement to arrive at the profit belonging to the equity investors in the parent company. As with the balance sheet, you'll also see various footnotes next to some items in the income statement. You can have a look at these footnotes to get more detail on various items in the income statement. You'll see that Ryman Healthcare also has a consolidated statement of comprehensive income. This statement starts where Ryman Healthcare's consolidated income statement finishes, with profit or loss. In Ryman Healthcare's case, this is called profit for the year. It then includes several items of other comprehensive income. Other comprehensive income are gains or losses that have occurred not in the ordinary activities of our firm. Other comprehensive income is not included in a firm's income statement. Rather, Ryman Healthcare includes other comprehensive income in a separate consolidated statement of comprehensive income. This includes items such as fair value movement and reclassification of interest rate swaps, that is, gains or losses on various financial instruments. Your firm may also show its other comprehensive income in a separate consolidated statement of comprehensive income, or alternatively, include these items in its income statement as a single consolidated statement of comprehensive income. Items of your firm's other comprehensive income may or may not also appear in your firm's statement of changes in equity. The balance sheet and income statement set out all 5 elements of accounting: assets, liabilities, equity, revenue, and expenses. Indeed, we could check whether the extended fundamental accounting equation works out for our firm by taking the numbers from our firm's financial statements and put them into the equation. Assets plus expenses equals equity plus revenue plus liabilities. To do this, we would only need to look at the balance sheet for assets, equity, and liabilities, and the income statement for revenue and expenses. So why do we need any more financial statements? After all, we saw in Chapter 1, Section 1.4 that there are only 5 elements of accounting. There are not any more elements or aspects of business that we look at in the business model underlying accounting. So surely we have it all covered with just these 2 or 3 financial statements. Well, yes and no. There are a couple more things about the changing nature of business that we're interested in finding out about. One of these is to do with changes in equity. Statement of changes in equity. As you look at your firm's financial statements, you'll see it will have another financial statement which may be called Statement of Changes in Equity. It can be called a range of different names, and on first introduction at a party may sometimes have a confusing appearance to us. In some ways, the Statement of Changes in Equity can be the most nerdy or geeky of the financial statements to meet. Do not worry, it takes a range of people to brighten and deepen the mix of our lives. Just go with it, and over time you'll get to know and appreciate the part played by your firm's Statement of Changes in Equity. This financial statement shows the various changes in shareholders' equity over a period. Have a look at it for your firm. Do not worry that you may not understand what some of the items are at this stage. Have a look at the general format of your firm's Statement of Changes in Equity. Try to make some sense of it. It will show opening equity, the profit or loss for the period, as also shown in the income statement, possibly various other items, often called other comprehensive income, and various payments or transfers between your firm and its equity investors, such as dividends or share issues. Usually, as is the case for Ryman Healthcare, it can have a lot of columns for each of the different items of equity, showing how each changed during the year. At this stage, do not worry about all this detail. Just have a look at the total equity column. After all, we're only at the stage of first introductions. Statement of cash flows. Never ever discount the idea of marriage. Sure, someone might tell you that marriage is just a piece of paper. Well, so is money. And what is more life-affirming than cold, hard cash? Dennis Miller. Finally, your firm's fourth financial statement is its statement of cash flows. The statement of cash flows shows the opening cash balance at the beginning of the period, which is mainly its bank balances on that date, although it might hold some actual cash on that day as well. Cash inflows and outflows during the period, usually a year, and the closing cash balance. Now, cash is an asset of a business just like any other asset. You'll see it is one of the assets in your firm's balance sheet. The opening cash balance is your firm's cash in its balance sheet 1 year ago. The closing cash balance is your firm's cash in its latest balance sheet. You'll see lots of other assets besides cash in your firm's balance sheet. Why do we have a special financial statement showing details about the changes in cash balances from one balance date to the next, and not also one for the changes in each of the other assets of our firm? The reason for this is that there is only one way a business or individual can go broke or go into liquidation, and that is to run out of just one of its assets, cash. If we do not run out of cash, no matter how big the losses we make in our business, we will not go broke and can keep on trading. However, the moment we run out of cash, no matter how many other assets we might have or profits we might be making, we are in trouble, serious trouble. If we run out of cash, we cannot pay our suppliers or our employees. This usually upsets them a lot, and very, very quickly. If we suggested to our employees that we could pay their salaries by giving them an office chair or perhaps a filing cabinet, they would look at us like they wanted to strangle us with both hands firmly around our neck. The reason for this is that cash is a widely accepted form of payment in our society. It is why people say cash is king, a sort of Elvis Presley amongst all other assets. No other asset on our balance sheet has the same negotiability as cash. We also saw in Chapter 2, Section 2.3 that we use accrual accounting. This means our firm will record in its accounts various transactions, such as revenue and expenses, when they are judged to have occurred, which may not necessarily be when cash is paid or received. It often is not. These judgments might be made differently by different people. That is the nature of judgments, after all. By contrast, the receipt and payment of cash in and out of our firm's bank account requires no judgments to be made by those preparing our financial statements. All they need to do is look up the firm's bank account. The statement of cash flows does not include the many judgments involved with accrual accounting. Trust relationship in business. Your firm's financial statements reflect the powerful idea that we can view a firm as separate to its owners. This simple idea has greatly influenced modern business. As we view a firm as separate to its owners, then everything a firm does has two effects. One on its owners, equity, and the other on itself, assets and liabilities. This is what our firm's balance sheet shows at a single point of time. It shows the assets the firm has been debited with, as the firm owes an obligation to its equity owners for all the assets it controls, and which are how the firm can generate future value to meet that obligation or debit it owes to its owners. Your firm's balance sheet also shows the equity and liabilities it has been credited with, each recognizing that someone outside the firm has believed, trusted, or credited it to repay them in the future. In this way, your firm's balance sheet expresses the trust relationship that exists between a firm and its owners and with its debt providers. Your firm's balance sheet shows that others have entrusted the firm with resources in exchange for IOUs, being equity and liabilities. It also tells us what assets the firm controls and which have the potential to produce economic benefits to repay those IOUs, that is, to repay their trust in the firm. The equity, or IOUs, of the business to its equity owners change in value over time as a firm either adds value or reduces value because of its activities. Receiving revenue from people outside the firm increases value to equity investors. Incurring expenses by paying people outside the firm reduces value to equity investors. Revenue and expenses are the two temporary elements of accounting. Instead of including revenue and expenses directly into equity as each transaction or activity of a firm occurs, we keep these changes separate from equity for a period in temporary revenue and expense accounts. At the end of each period, usually a year, we empty out each revenue and expense account and put the balance of all these accounts into a profit and loss account. This will be a positive number if revenue is greater than expenses for the period, a profit, or will be a negative number if revenue is less than expenses for the period, a loss. We then start out the next year with zero balances in our revenue and expense accounts. The profit or loss for a period is transferred to equity at the end of a period, as shown in our firm's statement of changes in equity. Also included in the statement of comprehensive income are other comprehensive income items, which are transactions or activities of a firm that did not go into the temporary revenue or expense accounts and did not end up in the profit or loss figure in our income statement. These are transferred directly into equity as shown in the statement of changes in equity. The statement of changes in equity also shows the transactions that occur directly between a firm and its owners, for example, the payment of dividends. The statement of cash flows shows some details of how cash changed between one balance sheet and the next, helping us to see where cash came from and where it went during the year. Now that you've been introduced to financial statements, let us consider in the next section how we can make sense of what financial statements might have to tell us about the economic and business realities of firms.